business, I now have to go there 2 times a day because of how bad earnings were.
Yeah, you bought a value trap, bro. It sucks. It happens.
All good.
Ladies and gentlemen, welcome to the SoFi Weekly. Today, as you guys can tell, we are joined by a special guest who actually was on last week, but he was avoiding me on purpose and making sure that he was only getting on the episodes where I wasn't. I had to offer him quite the bribe.
You were late.
I wasn't late. I was taking time away.
Yeah, that's called being late.
A full 24 hours late from the normal SoFi Weekly.
That's right.
The problem was I was on a plane both Friday nights, so kind of worked out where I couldn't make either one.
Yeah, I mean, really, you're 168 hours late, but who's counting?
Yeah. But I was on the earnings call. Where were you, Steve?
I was working, sir.
Yeah. Well, guys, SoFi had just had earnings. We got beat up. I mean, it wasn't like what we were expecting, being up after SoFi presented their normal triple beat. This time, after our triple beat, we went down 10% during the next day. Roy, what did you think about the quarter? I don't want to hear any specific, like we'll break down each individual thing, but just overall your reaction, was it justified?
No, it's a triple beat. Stock had not had a run up before, other than aftermarket or after hours. So the 10% drop wasn't justified. I will say, without getting the specifics, the actual results, really, really good for the most part. The things that they can actually control and that they made choices over, not so good. And it very much reminded me of last quarter's PayPal earnings.
Yeah. Tevis? You agree that it's a PayPal all over again? Good numbers, bad guidance?
I mean, I don't know, man. Like, I feel like people are harping on the quarter-over-quarter guidance, and meanwhile, like, management guided for what the year was going to look like, and they came in, and I don't see any huge variance to that guidance, and they raised the end-of-the-year guidance as well. So, I mean, anyways, we can dive into specifics after, but it just seems like if you're looking for an excuse, or if you're looking for a reason to sell the stock, or adjust your price target downwards, like every single earnings call, you will find something. It's just, is it material enough to actually make a difference in your thesis? And in this case, I don't think it is.
Yeah, we call that the Gary Gordon approach. Only the red stuff, and then create your argument that way. Steve, man, good to see you. I love the brick background. What are your thoughts? I read your article, by the way. I said this in DMs, but seriously, guys, make sure you go and read his article. Follow him on Seeking Alpha. He is one of the best writers on the entire platform. I love the way that you can, you write your ideas out. It makes 100% sense every single time you cover it, other than the thesis that you had for Block. But aside from that, one article every quarter or so, not a problem. What do you think about SoFi, though?
You need to learn how to read a cash flow statement and look at how much you're getting diluted. But we'll get there eventually. Black spends more money giving shares to their leadership than they make in profits. But cool.
Okay, why can you write it off for SoFi instead?
Because I believe in the company.
Okay.
I mean, look, obviously, I think that the market got it wrong. And I think the real question is, did anybody besides me buy?
A little bit, just a little, tiny bit.
I mean, look, it's very hard to take this seriously. And since I am not a short-term investor, I could care less. Look, nobody should do anything because I am doing it. I am good losing all my money on this investment that I put in because I know the risks. Studied the company. I think the market's wrong. I could be 100% wrong. At the end of the day, Mr. Market is always correct. But you have a company they gave you full year guidance, and last quarter they gave you guidance for not just 2024, not just 2025, but for 2026. You got a triple beat. Who cares about quarter over quarter? And I know that people are looking at this saying, oh, but the quarter over quarter revenue, this will be the second quarter, it's decreased. Who cares? You got full year guidance that got increased. And I think the problem now is that the market has gotten used to Nodo sandbagging and them coming out with triple beat after triple beat and raising guidance. And maybe that's working against us right now. But looking at their full year guidance, this is good guidance. And ultimately, the members are the ones that we need to listen to. And when you have more members coming on the platform and deposits growing, it's hard to say that they don't have a good product that's valuable, that people are really finding value with. And that's the barometer that I'm using.
Yeah. So look, I think, I mentioned this in an earlier video that I put out earlier today. And after having thought about the earnings a little bit, the transitional year, Anthony Noto was poked on that for the 3 interviews that he gave on Yahoo Finance, Bloomberg, and CNBC respectively. And they basically, touched on the fact that Q2 was going to be lower and the fact that non-lending segments were going to comprise of 50% of revenue. And I think that the conclusion I came to was, if you're an analyst who has historically always viewed SoFi in the lens of they're a lender, this is now changing that perception for you. And because the non-lending segments are a stronger contribution to the revenue mix, it forces analysts to look at this company in a more dynamic lens, because ultimately the lending segment is flat to down. And if you're always looking at it from that traditional point of view, you can obviously be more bearish than normal. Of all the comments you could have put up, you put up that one. There were so many good comments. But anyways, so my point is from an analyst perspective, like, I understand how they can paint it as, from a bearish lens, because they have historically always judged SoFi from the lending perspective. And now that dynamic is changing. The story is changing.
Roy?
Yeah, long term, I'm still invested. I bought a little bit just to top things off. And, I've got a chunk of money coming into the market a month and a half from now. To be perfectly honest, my allocation towards SoFi, when I put that chunk in, I'll buy some more SoFi too. But I'm more interested in other names right now. I think that, long term, things are going to be very good with SoFi, and I plan to continue holding long. Short term, I'm not seeing any reason to go heavier into SoFi. Just keep things where they're at, let things play out, add a little bit here or there, but nothing substantial. I just, with the caution that they're doing, especially in the lending segment, that seems unlikely to change. Macro situation, I don't know that that'll get any clarification to where Noto is satisfied in the short term. So could be wrong. Would love to be surprised, because I'm holding what I got, but that's just where I'm at.
Yeah, I mean, if you look at the option market, it is certainly not bullish, and the premiums are not big at all. I mean, I was trying to figure out, would I even want to write to try to bring in some income? And you got to go. I mean, I built my own calculator on it, and going out to July, which is the July 19 chain, which is 76 days. I mean, even writing contracts at a $9 strike is only bringing in, what is it, about 2% or so? And it's not, I don't know.
Yeah, that's my thing is I love writing options for additional premium, and SoFi sucks to do that. Usually it's good. And I think that we may be range bound for a while, honestly,
Yeah,
even
the
though it
option
shouldn't be this
market
way.
is not really bullish right now in the short term, which is fine. I mean, look, you bring in 2.5% on a $9 strike, and look, that's a 29% move to the upside. But it's also the middle of July, and you got earnings again in August. I don't know. I think the market's wrong on it. I'm adding when I'm able to lower my cost basis by a decent amount, which I was able to, but those days are getting very slim. And I think this is something you have to either believe in the long-term thesis or you don't. And quite honestly, they need to start, and I understand the RFP process, but at least tell us what large regional banks signed on. And I get it, you can't tell us who you're currently in an RFP with, but they got to show some movement on that because that's what's going to give them the hybrid or a tech multiple. Otherwise, it's going to be hard to really get them out of this whole framework of being just a bank until they can really show off and showcase the tech platform.
Yeah, I mean, you don't even necessarily need to show, in my opinion, anything with the RFPs if they didn't want to, as long as it's coinciding with revenue growth or margin expansion or something along these lines. I just went through the earnings call again once I got back, and so many extreme positives. It really, going through all the different little pieces that Anthony Noto and Chris Lapointe talked about actually got my excitement about SoFi up again. But some of the comments regarding, the growth in Galileo, the pipeline being extremely strong, these sort of things are so repetitive without actually seeing results. I don't necessarily think that the market cares at all that the pipeline is as full as it's ever been. The fact that they're simply, not growing as fast as people want them to is what's holding them down.
Well, and keep in mind, we understand Galileo, we understand the RFP process and technesis, but the average person that doesn't follow SoFi as closely as us, this is speaking a different language to them. And I think that they need to do a better job of really outlining how critical these components are and why they are going to be the AWS of fintech and what these companies allow not just them to do internally, but what they allow them to bring in from a revenue standpoint externally. And I just don't think that a lot of the analysts on the street actually understand this, and I don't know if they're really looking into it.
Yeah, look, I think we've been so range bound, again, from a stock perspective for so long that I understand the pendulum swing of saying, okay, we don't want a management team to overpromise and underdeliver in terms of building up hype just for the sake of pumping their stock. And then on the complete other side of the spectrum is SoFi that plays their cards super conservatively, even when in many cases they might not have to, because they could absolutely take a more risky approach and come more in line with what the base case is going to be. But they go super conservative relative to that. I just personally think that the average person, and looking at all of the comments and reactions from the earnings, it's so evident to me that a lot of people just are not thinking about this from a multi-year perspective. They're thinking about this from a much shorter time frame. And if we're looking just at the short time frame, there's so much downward pressure on them because the stock has been trading in such a range for a long time that all I want them to do essentially in the short term is, or not I want them, all they need to do in the short term is build up that excitement to the point where this thing breaks that range. And so that the psychological downward pressure is broken. And then it can be business as usual, because right now we're getting into a further disconnect between the company fundamentals, which are continuously executing, and the actual stock, which is stagnant to down.
And that's an important point because the stock and the company are two different things. And you have a company that is now net income profitable. You have financial engineers that were able to take advantage of a situation and shore up the balance sheet. And we are on track to continue hitting the metrics that they're setting forward. And I think that when they're guiding 8-9 cents this year, that really means 11-12 cents or 13-14 cents this year. And then that puts us on track to hit 55 to 80 cents. And that's a big range. But that's the range we were given. And I got to think we're going to come in the midpoint of that somewhere in 2026. And if you do, you're talking about trading at 11 times 2026 earnings at a midpoint, maybe even high single digits if they continue to deliver on their critical success factors. So from a company standpoint, they're doing everything they need to do. It's just right now there's a disconnect with the stock, which is okay because you know what? Stocks don't go in a straight line up. sometimes there's a lot of pain. I mean, you look at Block, for instance, with Tanner, that was down for a long time and it's starting to rebound. You look at PayPal, great company, perfect example of a company and a stock that's completely disconnected.
Yeah. Look, I don't think that they're going to come in the high teens in terms of revenue growth, which is what people are now expecting for the end of the year. And I don't think they're going to come in that 55 to 80 cent EPS range in 2026. I think they're actually going to beat that range because that range forecast doesn't account for new product lines. It only accounts for the organic growth of the existing product lines. The problem is that it's very difficult for people who are not as in the weeds as we are to see the path forward of how we get from point A today to point B in 2026, and what happens in between that time. There's execution risk baked in. There's all these expectations on management to continue to deliver on new product lines that we're confident in because they've done so in the past, but because we've been following them. But somebody just looking at it, from a perspective like somebody who's done maybe 2 hours or 5 hours of research into SoFi might not have that level of confidence that we have.
And I think it's, do you have 5 years? Because if you have 5 years, this looks really interesting because there's a lot they can do in 5 years. You should have business banking up. You should have asset management fully expanded. You should have custodial for 403s and 401ks. There's a lot of things that they can do to generate revenue. Why are you laughing, Tanner? Are you reading comments?
I'm reading comments because there's this guy in the chat that's just continuously saying this is dead money, and then he just said he has 10,000 shares.
Well, whatever.
You know what? If you don't like it, sell your shares and place it somewhere else.
I mean, look, you either believe in this management team or you don't. This is a company that had to pivot on a dime when the student loans were shut off. That lending business was completely hamstrung. And look at everything they've accomplished. If you don't think that they're going to build out the rest of these verticals, then this isn't the right company for you. But if you believe in that, there really does look like a very long road of growth ahead of us. And I am still very bullish on the tech platform, as I don't think people understand that a lot of banks have been engineering their tech platforms internally, and they're going to need to go to a cloud-based platform. There is a ton of new regulations coming down the pipe. There's only a handful of companies that are going to be able to provide this. SoFi is one of them. Like, this could be absolutely huge.
Let me show you guys something that, and I was looking for this like for several days. I finally found it. This slide has nothing to do with SoFi, but it's how I would like to get some clarity on the tech platform. This is from a company, Innovix, that I briefly invested in. Then it doubled. I'm like, hey, that's fine. It shouldn't have done that at that point. Maybe it's a good investment, maybe not. But we're here for SoFi Weekly. What this basically was is pre-production phase for Innovix. They're gearing up manufacturing lines of different things, and they had some really neat features. So they ended up key coding all of these, so you can see the different colors. I'm kind of colorblind, so it's not super helpful there, but you got the different market classifications, so you kind of know what product it is. And then you have the account code here that goes along with the number. So K29 would be a key, a top 10 in that field among the wearables. Number 29 would stay the same. And so you'd actually see where clients move through the funnel. Down here, the funnel milestone would tell you how many units were actually in production. So engineering sample, just like 10. Customer sell is just 10, and as it moved through the funnel, and then also a milestone duration. So it tells you like 3 to 9 months, 6 to 9 months, 4 to 6 months for each phase. So you can kind of get an idea of where you're at, what kind of products, that they're actually looking at from Galileo. It's not easy to do, but this was, at least for me as a shareholder of Innovix temporarily, is like 3 or 4 months, was invaluable because it helped me, first understand before I got in there. It's like, is this just all smoke and mirrors? Probably not, because who was in it, but that's what people are wondering. I don't think so. I know Anthony Noto. I don't know him, but as an investor, I know him, and he's credible. The people there at SoFi are credible, but a lot of people are wondering, like, hey, what kind of products are people looking at? What kind of customers do you have? How long are your phases expected to last? How are these companies moving from place to place in that pipeline? I don't think this would pump the stock, but it would give us a lot more information as investors. And I would find that very helpful, rather than just occasional updates of like, hey, we got the top 5 in this. That's, and let me reiterate how long this cycle is. And so you may never see it until you're 80. Not really, but I mean, this just helps so much. Takes a little time to do, a little effort. If anyone from SoFi is listening, like, please pitch this idea. What do you guys think?
I mean, could be good. I don't know why they're not giving more information. So it's just speculation at this point. So I don't know. Tevis?
Look, we had this discussion, I think, the last time we were on, and my answer this time is the same as my answer last time. What is the purpose? What is the end result that they're trying to provide for that? If awareness, why and to whom are they trying to provide that awareness? Like, what is the end? What is the benefit for SoFi to provide this, other than they now have a more scrutinous lens by which people can judge their success or failure?
No, I honestly, I think that's the wrong way to think about it. I think as investors, it's not about, you don't want to be behind a stock that is being pumped up either, right? You want to know what the red flags are. So I think that the market is really good at swallowing good news, bad news, but cannot do uncertainty. So if things are turning sour at Galileo or something like this, it's very important, even then, to showcase that things are turning around. So then you can make that, that decision to potentially sell, not other investors. I'm talking like literally me and you.
Yeah, I mean, look, you could definitely make that argument. I'm not like absolutely, no, but I think that even the retail, first of all, many of the analysts discount the technology platform because it's not a big contributor to revenue. And so if Galileo client pipeline was low, let's say, well, Galileo only does like 94 million in revenue anyways. It's like a third of what the lending segment does. It's half of what the financial services segment does. And so analysts will discount it. And for the retail crowd, Galileo is really, a symbolic directional play that's multi-years out for it to, actually play out in the growth story. It's not like this quarter for next quarter, what is the pipeline going to be looking at, right?
But
So
it's important because it helps differentiate them from being valued as just a traditional bank. And most of the people probably don't even realize that the combination of the two saves SoFi between 65 to 80 million a year in expenses.
Yeah, but Steve, by whom? Like, so for example, the retail investor crowd already doesn't see them as a bank. Like, we don't see them as a bank. They are a bank. They have a strong banking presence and component, but they also have that technology aspect. And so we recognize that even though we don't have that level of granularity. An analyst is what I'm saying is an analyst won't recognize that even if they do have that level of granularity.
I don't think that's true.
Well, all they're going to see, or at least what they're going to lead with, is the revenue or lack thereof of the technology platform, the percentage of the revenue mix. And my point that I'm trying to make is, if the tech platform in a parallel universe is 50% of SoFi's revenue, analysts will judge it way more as a tech company than today when it's a fraction of the total revenue mix and it has granularity in terms of the pipeline. Like, how big of a contributor is it to revenue is the main parameter by which analysts are judging whether it's a bank or a hybrid.
Main, but not only. And the thing is, there's 3 main segments for SoFi. This is one of them. It's one that we know very, very little of. And if it's actually significant to their future, which all indications from the way they talk, it is, them continuing to just, have these very obscure timelines and information is not helpful to take that credibly. So, I don't blame the analysts at all and yes, revenue is most important, but I don't blame the analysts at all for discounting this and just saying, you know what, maybe we'll give it $1 for the tech platform. And that's it, as far as a price target, nothing else, because they don't know. Like, how are they supposed to judge and determine what the tech platform's worth when they're hearing the same thing that we are? And it's like, well, there's these large clients that maybe will land at some point in the next few years because they could take a few quarters to onboard. That's all we're given. So it's really tough. This gives an extra piece. And, I don't know that it'll move the stock significantly, but for me as a shareholder, it helps me really know what's going on with 1/3 of SoFi. And frankly, the tech platform is why I invested in SoFi. It's not because it's a bank that's growing fast. So we see the rates because of their choices with lending very conservatively. And, I disagree with them being this conservative, but whatever. It's like the tech platform keeps me interested. Otherwise, I'd just be like, you know what? there's other banks I can invest in if I want to do that. So, and I don't want to just invest in just a bank.
I
So
think the exciting part about SoFi. First off, is everyone good on the Galileo thing? Because we're already 25 minutes in and we haven't even covered any of the numbers or anything.
Yeah, I just want to say one last thing on that. I don't know if you guys saw any analyst notes this week, but there was an interesting one from Cavarini, who actually raised his price target by $1. And a lot of them, I mean, the tone was negative, obviously, because he's like a bearish analyst. He has an underperform on the stock. And a lot of it was around risks, around delinquencies and such. But he also mentioned a portion on the tech platform, which I hadn't seen in previous notes. And basically to say that, one of the things that he was saying was, if they're going to have a soft Q2, it's going to be a big effort for them to make up for it in the back half of the year. And that the technology platform and financial services, because it's going to be 50% of the revenue mix, has to actually have a high load to lift to carry that. And I thought to myself, okay, that's interesting. Analysts discounted the technology platform for so long, and all of a sudden when SoFi said, oh, it's going to be a big contributor to whether or not we make that guidance because it's now a bigger percentage of the revenue mix, now is when analysts are including it in their notes. And so he was still bearish, but he still raised his price target by $1. And I think that is ultimately what's going to put the technology platform on people's radars, is if management counts on the technology platform to consistently hit their targets, then analysts have to account for it as well.
They need to show the potential. It's not going to make up 50% of revenue tomorrow or even next year, but they just have to do a better job of showing the potential of what it can become and what steps they're taking to make it become that. And in the shorter term, the critical success factors are going to be business banking. It's going to be asset management. Those are things that they can roll out on their platform sooner than they can win RFPs, because it's not just about winning the RFP. It's about the implementation phase that comes after that. You may not start generating the incremental revenue from the tech platform for 2 or 3 years when you add up what stage RFP they're in and then implementation and going live. So
I think you guys need to pay attention to what they're saying in the earnings call, because I think the earnings call shows you what they are planning on pushing. And it's not business banking and it's not lending.
credit cards.
Credit cards, exactly.
Business banking is huge, Tanner.
I know, but you're talking about, you only have so much manpower and capital to go after.
But it's a parallel of what they already have. It's low-hanging fruit that all they need to do is replicate what they already have, and then they can start business banking platform. We know they're going to do business lending, and then we know they want to beef up their asset management, becoming a custodian such as Vanguard or Empower or TIA Craft, one of these big 401k managers. That could be huge for them in the long run. Absolutely huge. And drive book value.
I'm not arguing that. I don't think that those aren't part of my ultimate goal for long-term SoFi. I'm saying in the short term, what people are arguing about in the stock price, I think people are not pricing in what credit cards can do for the business. And that sounds like a small product for SoFi right now, but there are a lot of companies that have built massive $50 billion, $100 billion companies off of that product alone. And now SoFi is saying that they are getting enough of the data to actually start ramping this. They're going to start increasing it on the back half of 2024. The defaults are coming down drastically. It's potentially one of the highest ROE products that they have in their entire list of products, including personal loans. And I don't think you have to look too much further than the things that they already have on their shelf right now. I don't think that is the next catalyst is SMB banking. I think that the stock can turn around with the products that they have on shelf, and that's SoFi Money, SoFi's credit card, and personal loans.
Well, what you said was very important, them harvesting the data, because it's a very good point. And when you have over 8 million members and you're collecting this amount of data from them, and 90% of the accounts are open to direct deposit, you can push products the same way Noto said on the call. They know what products their members are in line for and what could help them, and they can push those promotional products to them. there's a lot of things that this company can do over the years. I think that we are in an accumulation phase. I don't know what can get it back into the $10 to $12 range in the immediate term, but I'm also not in it for the immediate term. Like, this is a 5 to 10 year play unless something completely changes.
So
The nice thing about credit cards is that it's been a drag. So if we have a very low bar for credit cards, which we shouldn't, I think this could be profitable. There's no reason why it can't, especially with the data advantage that they have if they're just trying to cross-sell that to their own members. Like, they know people because they're like, hey, we have your bank account, we have your direct deposit information, we know your income, we know your credit score, so have a credit card, and we feel pretty safe about offering you this. But if very low bar, I believe it's $100 million drag. If they can just
$100 million annualized between invest and credit card.
Thank you. I was like, that didn't seem right with just credit card. But if they can get that drag net, invest might take a little while. I'm not sure. But with credit card and invest being just a zero, that's a huge increase. And that's not like a very high bar of like difficulty to just get a net zero on invest and the credit cards.
So I think if we talk about credit card, the interesting thing that Anthony Odo dropped in the earnings call was that we can expect some more innovation in credit card product in the back half of the year. That was his wording, essentially. Expect more innovation in the back half of the year. Paraphrasing, maybe Tanner has it up. But I'm just looking at the earnings release. I mean, credit card, okay, they're investing $100 million. They're trying to get it up. I understand the value that credit card provides. The defaults are going to come down as they keep growing. It's going to be a profitable product. Credit card is still like, 10x smaller than invest. It's still like 20x smaller than money. And that would be fine if it was the fastest growing product. It's not. Referred loans is growing faster than credit cards. It's like, it's towards the...
That's not true.
It is true. I'm looking at it right now.
Credit cards grew by 9,000 products. Referred loans grew by 3,000. That's not true.
I'm talking from a percentage point of view.
Okay.
So from a percentage point of view, referred loans grew 34%, credit cards 32%. Invest was flat. I mean, they're also investing in invest, and invest is flat as well. Like, money is the main thing that's growing fast, and it's also their largest aggregate from a product perspective on financial services. So, like, I understand the benefit to credit card. I just think that...
I think you're brushing past the idea of it being for second half of 2024. I don't think they're currently... I think they're in the learning phase still.
Sure, but it's going to take a while to get there is what I'm saying. It's not going to be something that's going to materialize this year, that even if it is Q3 or Q4 this year, fast forward to December, I don't think we're going to see, credit card making a surprise comeback. It's going to be probably a 2025 thing. If that.
Can the SoFi credit card compete with Robinhood Gold?
Oh, wow. I don't think that that's an appropriate question. Can any...
Of course it's appropriate.
Okay, so then don't invest in any credit card company because none of them can compete with a card that doesn't exist yet.
That's not what I'm saying. It's a legitimate question. Can it compete with Robinhood Gold? Because if somebody is going to sign up for a new credit card, you have options.
But people at JP Morgan have higher APY options. They don't look. They're not shopping. They go
Also,
with the advertisement.
How hard is it to go to NerdWallet?
Also, Steve,
it's not about that. Only 100 million visits a quarter. Like,
hold on. It's not so mutually exclusive, because the amount of people that have multiple credit cards is like, there's no barriers to entry. You can have both. You can have
you guys seen my background? I've got like 6 here.
Yeah, that's the thing, is it's not winner take all. If it was, Robinhood Gold would trounce everybody else, and Robinhood might go out of business.
Capital One would go away.
It's not winner take all, but there are more options today than ever before. All I'm saying is, can the SoFi credit card compete with Robinhood bringing their product out now? I don't know the answer to that. I'm not bullish on the credit card aspect. Doesn't even compute into my stuff right now. It's the least thing I'm excited about.
I mean, I think that we'll have to see. But if you look at what they're saying, I'm just trying to look for ahead, right? And right now, no one's talking about spend on SoFi, and the numbers that they are coming out with are insane. Like it was probably the most exciting beat in the entire quarter. Although it makes up for a nominal percentage of the overall business right now, those things change very quickly. So what I'm referring to is SoFi Money right now. SoFi Money added 500,000 new accounts, and that is on top of, that is inclusive of the people who actually closed their accounts. And on that, they said overall debit transaction volume exceeded 1.9 billion in the quarter, up 20% from the prior quarter and up 150% year over year. On their forward-looking guidance, they said you could expect the same relative linear growth with spend over the course of 2024. So that's 20% per quarter for the rest of the year. And then you're saying that potentially that's not going to matter if they bleed into credit versus debit. Like I think financial services is going to make up for such a large percentage of this company. And I think it's going to change the way that people value this company because it's going to reduce risk on lending. Everyone wants to talk about the tech platform, and the tech platform is exciting in principle, but not in growth rate. Right now, I could care less about Galileo. I care about SoFi Money and the financial services platform. It's booming.
And what is a financial service aspect? Business
Credit card.
banking.
What?
Business banking.
Yeah, I mean, potentially.
Yes.
And I think that you're 100% right in the long term, but that could be, like I don't know. It'll have a slow ramp. I don't necessarily think that every product that SoFi rolls out is going to be a slamming success, especially whenever the cross-sell is not going to be very high because there's only so many business accounts.
But now's the time to get it while interest rates are this high, and nobody will be able to compete with SoFi on APY for business banking. You have a perfect setup for it. Now's the time to add that vertical, because once a business comes in, they're less likely to go to a JP Morgan or a Bank of America unless they are a huge company with a huge payroll. So you got to get it while the going's good. And right now, rates are 5.5. You can give a very big APY on it. They should add it while they build out their asset management, and then everything flows up to the financial service segment. I agree with you. It is one of the most promising aspects of the company, and it is something that can continuously be built on. And you get the different verticals because they've said previously they're building out more mutual fund access and more of their own ETFs. You get the management fees on their own proprietary funds. And then if you add business banking and you have those relationships, you bring them on to custodial their 401ks and 403bs, and you put options in those plans for SoFi's proprietary index funds, XYZ. You double dip. You get the management fees from the funds, and then you get the custodial fees for the actual plans. I mean, this is critical to the forward success of the company.
Yeah, but
And I think the brick that you're running into is just the fact that they are just recently fully rolled out dark mode,
Well, not only that, but any new product line that they release, let's say we wake up tomorrow and they release a new product line, they release, business banking, they release whatever, that's going to take so much time to get ramped up and actually hit some critical scale to actually be a big contributing factor to the revenue of the company. And whatever they release today, it's probably going to hit the ground running and probably early 2025 to actually be something that is worth talking about and not something in investment mode. And that's just a fact. And I think I agree with Tanner to the point where financial services is right now the most exciting thing about this company because it grew 86%, and they're saying over 75% is what we can expect going forward. So the technology platform, like I said before, it's 94 million in terms of revenue. It's exciting if I look 2026, 2027, what it could become. But in terms of the actual growth rates right now, like money is carrying a lot of SoFi from a products perspective, especially when lending is not going to be there to have that growth rate. Financial services is going to quickly catch up.
One of the things that actually excited me was that financial services productivity loop slide, which we've seen previously. If you can throw that up, they added a word. That word is inflection point. I guess 2 words. it wasn't mentioned in their earnings, but they said, hey, it creates marketing efficiencies. Of course, it improves X buy, cross buy. But they're killing it in this segment. And what's interesting is this is at the same time as marketing and sales are down by 9%. So it's interesting that they're able to do this, what they're able to do, and we'll see how the NBA partnership, when all that hits, how that plays out next quarter. But this is creating some efficiency for them that just kind of excited me. I've got a little post on that coming next week. So,
Tanner,
but no, I
members.
Pardon? Sorry?
Go to members.
This is just a picture. So
here, I have
the actual deck.
So I have the presentation here, but I actually have a big problem with this members page, and I don't know if you guys have talked about this yet, but go ahead.
I mean, what's your problem with it first?
My problem is the difference between 7.542 million and 8.132 million is not 622,000. It's like 580 something thousand. And that they are covering this large ad, but it's not inclusive of drop-offs.
Yeah, they need to include that line. New members is fine, but have the drop-off line just so people can see it. It's more transparent. Somebody pointed that out and they were like, hey, they're doing wrong math. And I'm like, I know that they talked about something like this. I couldn't remember what it was at the time I was working. So
no, it's not wrong math. This is new math.
They should have the drop-off, but and just have they should have a new member line and a net member line is what they should have.
Yeah.
That way the net will cancel both out. But when you look at this is golden for the simple fact that if member growth was going in the opposite direction, there would be a very big problem. The fact that we continuously add, and this was the second best quarter for new member ads, and over the trailing 12 months, you have not had a quarter under 575,000. You never had a quarter of 575,000 new ads pre the past 4 quarters. And then you look at the correlation between new member ads and deposits. You had 2.98 billion in new deposits over the past 3 months. They're growing at a 16% year over year or quarter over quarter rate from Q4. And when you look at the way that this is going, if the product wasn't adding value to individual member lives, they wouldn't stay on the platform. Or would they get these ads? Like, these members are most likely coming due to word of mouth or somebody knowing somebody that's happy with the product. Some are probably coming from the advertising ventures with the NBA and the football stadium, but I don't necessarily know how many are actually coming from just seeing the SoFi brand somewhere. And this is who we need to be listening to, not our opinions or other people's opinions about if the product is good or not. The people that are using the product and sticking with the product and growing the product.
100%. And so this is another thing that I think that people need to look back on. The stock does this, and crazy things can change, and there are real negatives that have happened over the course of time with higher interest rates potentially staying much higher than what Anthony Noto and team had suspected. But not even just them. It's not even that they were being overly optimistic. They were actually below the potential 6 rate cuts. Now they're looking at potentially maybe even only 1 for the rest of the year. So we're in just a bad environment. I think that during those times, you can either sell and try to time the market better than most. I'm not able to do that. So I look at a company that continues to have charts like these up and to the right and growing in harder environments. And it could potentially be that alpha or that difference between what the market sees versus what the company is actually doing that could potentially have a turnaround in this play, especially whenever macro turns around. Once that happens, I think that this is a beautiful play.
If you go to products for a second, I mean, to Steven's earlier point, like, I think it's important for us to call out where we're seeing the majority of this growth and use that as a lever to try to make some assumptions about that growth going forward. Money added on a year-over-year basis about 1.5 million products, and Relay added about 1.4 million products. Those two is like 3 million products. And so looking at this, chart, you're at 11.8 million. If you just consider the growth in money and Relay, those are the two individual line items across the entire business that are adding more and more and more on an aggregate basis. And so every quarter, as you look at that financial services productivity loop, it's going to get money and Relay are going to become a bigger and bigger chunk of that pie. And there's good and there's bad. With that, the bad is that obviously we don't make as much money from those segments. The good is that those segments are low barriers to entry product lines that introduce people into the ecosystem. And so how that changes over the course of the year, I don't think it's going to be anything drastic, just because those products are easier to set up for users than anything else in the ecosystem. You're more likely to set up a Relay than you are to get a mortgage.
I agree. I just think that the people who set up Relay are able to cross-sell into mortgage, and the cost of acquiring that customer would still remain at zero.
Absolutely.
So it actually makes the total lifetime value of that customer exponentially higher. So that's where I think that looking at just sheer products isn't necessarily fair. Or with SoFi Money, the funniest thing about this product is that at first glance, 2 quarters ago, we had no idea where the margins were going to lie. Okay. Because we're in negative contribution margin for financial services. I don't know if there's a slide for that, but I'm not sure if there's a slide for that. I have it on my own thing, but I can potentially click over to that in a second.
Can you go to guidance real quick, please?
Wait. Let me don't change the topic. So just really quick on this. On the SoFi Money thing, before we were in negative margins. Now, in the matter of 2 quarters, we went from 3% contribution profit on SoFi's financial services, which is essentially all money, SoFi Money. Then we went to, 18%? Then the next one was 25%. That was the most recent quarter.
It's a chart on there, Tanner. If you go down, there.
This?
Up. There.
Are
we talking about the EBITDA?
No, I'm talking about contribution margin.
Oh.
So just only for financial services. I have a chart on my spreadsheet here. Let me just. So anyway, the reason why I'm bringing this up is that that's inclusive of the losses of SoFi Invest and SoFi credit card. Okay. So the potential margin on SoFi Money could be as high as freaking 40%. Like, we don't know. So as those turn around, right now they're holding negatives. They could not only, just get to break even, which would put a massive positive impact on margins for SoFi Money, but also if they start to add new potential profits, that's going to be a multiplier on their contribution profit going forward. So we still have so much margin expansion on those products. I don't necessarily think that seeing SoFi Relay or SoFi Money as being the larger contributors is necessarily a bad thing. They're potentially higher margin than Galileo and Technisys.
Just before we go to guidance, and Steve will guide that conversation, I just want to add one thing really, really quickly. I know earlier in this session, you guys basically have had an ask for management to provide more details around the technology platform pipeline. I think if I could have a wish list item for management, it would be cohorts, to see how the cohorts every quarter break out, because that would allow me to judge over a course of time, let's say 3 years, which cohorts have expanded more to cross-sell into other product lines. And that would be a really interesting aspect to break it down by. Go ahead.
Yeah, you set up as a quarter-over-quarter bar chart. I mean, it's just brilliant idea. Love it. Palantir used to do it. Wish they would bring it back. But yes, SoFi should 100% make that a slide going forward.
Here, if I can just show you this thing really quick. I have the spreadsheet. I don't know how big I can make it, but this is their contribution. Yeah, it's a little bit small. Let me try to make it as big as possible. This is their contribution profit. So before, this orange bar was financial services. This was a massive drag on total contribution profit, meaning that just expenses that are attributable to those segments. Now, in the last 3 quarters, we went from 3 million to 25 million to 37 million. We have to remember, on an annualized basis, credit cards and invest are doing negative 100 million, which is 25 million a quarter. Okay. So as that starts to turn around, you can potentially add, if it was just linear, an additional $25 million from those 2 segments if they were just flat, no add to these bars. So massive increases, and then you can see where the margins have gone: negative 67%, negative 30, negative 4, plus 3, plus 18, plus 25. This is no longer a bad product at all. It's going to pass Galileo and Technisys and become the second most profitable segment in the entire company. Financial services is where it's at. Another person said CAC is really high. CAC did a pretty good freaking drop this quarter. Like no one's talking about the small stuff that are large compounders for this business. Like, everyone's focused on fair marks and shit, but like that's going to change as the macro changes. Let's focus on the things that they're doing right now that are multi-year compounders. Look at G&A, sales and marketing, technology development. Across the board, expenses are coming down. Why haven't we not spoken about what's it called? The largest bear case 2 years ago was what is it called? Anthony Noto's compensation.
Stock-based compensation.
Stock-based compensation. It was 20+% before. Now we're less than, I think it's like 8.5%.
Anthony Noto's compensation. You gotta love it.
And don't forget, that doesn't even get paid out if the stock doesn't hit certain metrics.
Yeah, I
It's
love
all
that.
performance-based.
Yeah, like people are so focused on the overall, what do you call it? Like the overall stock price. But it's like, why don't we look at the things that are actually improving? Like this company is getting better and at cheaper prices. So the reason why I continue to make videos and I haven't sold SoFi based on the price being stagnant over this period is that it becomes a better and better deal, in my opinion, if I think that these compounders are going to stay consistent or even getting better over time. And that's what the heck we're seeing, dude. Like,
and let me jump in there too. Like, the reason why the numbers were softer than I hoped was because I didn't take them at their word that they were going to deliberately be very cautious on lending. They kept their word. There weren't much surprises there. But Chris Lapointe had a good point. Not that. Whoops, pun. But no, he had a good point where he said that they're not capital constrained at all, that they can loan up to 20 billion, or they can originate another 20 billion in loans without even coming near the limit throughout this year. And, of course, they tend to be a little bit more cautious on that. So I expect it's, an even larger number than that. So if for some reason, like, I don't expect this in Q2, the way that they've worded it, it's very, very clear it's not going to be Q2, probably not Q3, maybe not Q4, maybe not for 5 years. But at some point, if they just decide like, hey, you know what, there's a loan demand out there, we can make just an incredible amount of loans, that will be a face ripper earnings. And it's their own choice and their own caution. Maybe it's warranted. I think it's a little bit too cautious. And so it's not like, that they're trying to sell these loans and nobody wants them. They want them. And SoFi's like, well, no, too bad. They're ours. We're not going to sell them to you. The moment that changes, the trajectory of this company changes immensely. And they can do that. Like, Noto can just wake up tomorrow and be like, you know what, guys, let's pump it. It's time to get my RSUs.
Steve?
You want to talk about guidance?
Go to guidance.
Yeah.
Oh, sorry, guidance. Yeah. My bad. You want Q2 or full year?
No, full year. We're not short-term investors.
There you go. I got this.
Next slide. This is what people should be focused on. And I think this is where I got really annoyed. It may not have came off it in the article. I probably changed it, but I was fairly annoyed that people are overlooking the guidance bump that we got. And when you look at this, this is a big bump from the prior guidance. A lot of people were pretty ecstatic with the guidance that we got a couple of months ago. And then not only did we get a bump across the board, you got margin increase on net income and diluted EPS. I mean, this is pretty phenomenal here. Going from net income, and look, there's an asterisk because of what they did in Q1, but you can't deny that everything continues to work out the way that they envision it. And you have an annual growth rate on revenue that's going up. You're at a 25% adjusted EBITDA margin, and in 2022, it was 9%. I mean, if that's not progress, I don't know what people think progress is. I mean, this is a company that hasn't even hit its maturity yet and still has a lot of levers it can pull, still has a lot of products they can put into development and implement. And this really is a strong foundation of what the future could become. And I think people need to start taking the guidance more seriously. And this, once again, is a segue to that 2026 number that everybody thought was bullshit when he gave it on the earnings call. I mean, you had prior guidance of 7 to 8 cents diluted EPS. It's Q1, and they're already increasing it. You know you're going to get another one next quarter and another one after Q3. This number is probably going to be anywhere from 11 to 13 cents for the end of the year.
I think it was a serious miss on Anthony Nota's part to not reiterate the 2026 guidance.
Agreed.
Yeah.
Agreed.
You need to say that all the way till it lands the same way you did Q4. Q4
same way that they talked about GAAP profitability,
mm-hmm.
The same exact way that they kept hinting and saying in, and then we dissected it and we started saying it, and they started saying it more in Q4, GAAP profitability. And they need to start, just like you said, 55 to 80 cents GAAP EPS and start making that range a little tighter every 2-3 quarters and really start leading into it
to the upside. I think it's just a matter of them right now. They cannot predict rates. It's extreme. Like things are leaning more to the unpredictable side. That's what they said. They said if we lean more to the conservative side, we can always go up, but we don't have to go down. Right? So they're leaving themselves that leeway to change their mind going forward. That's why early on in this year, even before, I said, you know what? I think that we'll get 12 to 14 cents of EPS actual this year. And you're seeing the first quarter of changed guidance, 8 to 9 cents versus 7 to 8 cents. And that obliterates the analysts that were saying 7 cents for full year. And it'll continue to climb if they continue to beat, which they have since they've been a public company. I think that's a fair bet to make as an investor.
Can you guys remind me of how much the senior convertible note sell benefited over the course of the year off the interest savings for SoFi?
40 to 60 million.
Yeah, that's why I wasn't excited by the guidance, because you look at that and it's not even that.
What do you mean? Sorry.
So the raise in guidance for 2024, when they sold the senior convertible notes, that amount, if they just added it in here, would be more than what they actually raised the guidance by as far as the adjusted net revenue.
No, it isn't. It's more. Net 95 to 105 is a 70 million change, not a 40 to 60 million change. So if you just take off I think that the problem, or the thing that I hate with these gap changes, is that you have to start looking at the company in two lights. You have to look at it with the added debt pay down of 59.2 million, and you also have to look at it excluding the 59.2 million to see if without it would they have succeeded their goals. And they did. In fact, they came really close to the guidance that I said, which was they obliterated mine. I think it was like $35 million of GAAP net income, excluding the debt pay down. Which is...
Yeah, it was 30 million, 29 million.
Yeah. So there you go.
Can you go to the previous, or the Q2 guidance? I kind of want to pivot us to that if we're done here.
Tanner has sharp elbows tonight. I've never heard that. What did you say? Sorry.
Can you go to Q2 guidance, please? So this is the part that, upon second reading, I was like, oh, that's interesting. I went back and I looked at the analyst expectations for Q2 revenue, and the analyst expectations are 575 million. Here, the top end of SoFi's range is 565 million, meaning that if they beat this, they would essentially meet analyst expectations. Am I reading that incorrectly?
I need you to say that again. I missed a little bit of it. So you're saying they need to beat.
So analysts forecasted out. You remember that chart I showed you guys that showed EPS that was like 0.00 whatever? It went out as far as Q2. In Q2, the revenue estimate, the top line estimate for analysts was 575 million. Here, the guidance that they're providing for Q2 is 555 to 565. In other words, they would have to come 10 million above the top end of their range just to meet analyst expectations for Q2, which is, I mean, it's a high lift for us to expect them to beat in Q2 because their range is under what analysts are currently expecting for Q2.
But that's already priced in. That's why the stock is going down. I don't know. I think that you'll see analysts revise their revenue. I think that it's probably best to just add the two together because the large beat in Q1 already. That's the important part, right? Even if you look at it from H1 2024 and H2 2024, and you put all of it in Q1, that's actually better because you're letting them compound with the money in their pocket. So,
yeah, I'm not saying like it's like anything bad. It made me wonder whether we can see a quarter upcoming where we don't see a triple beat. And I know at some point it's going to come that we're not always going to see a triple beat forever. I just wonder if Q2 is going to be the first one, because from a perception point of view, like ultimately none of this matters because they raised their guidance for end of year and we can trust that. But from a perception point of view, if you think 10% downwards move was bad on a triple beat, imagine when they don't do that.
Yeah, this is a combination of essentially what they said is that they're going to continue to be restrictive on lending because they don't know where rates are going to go and they want to be more conservative. And they also, just seasonally, Galileo is slow in Q2. It's the slowest quarter. But that has happened historically. So they're saying that there are headwinds for those segments and that they're going to be leaning a lot on financial services. I don't know. I think that they will crush all three of these estimates. But yeah. Roy?
Yep.
Any comments on Q2 guidance? Scare you?
It's not very transparent. Like even the way that Noto answered some of the analyst questions were, I don't think they're necessarily hiding things, but it was good numbers, but just not what I wanted from the earnings call itself. More information is better. I don't like when questions are dodged, when things remain obscure, when shareholders have asked, like even down to it was actually a plus, and you helped me out with the name of it, but it's normally a drag but the last few quarters, the operations, not operations, was actually a positive, and we were expecting it to be a negative. I don't know what's going on with that at all. Chris Hager, actually one of the reasons why I thought that my 2.5 cents wouldn't hit is because I was looking at that as a zero. I was like, hey, maybe it's just going to be a zero from here on. And then he mentioned some comments when he emailed SoFi Invest, and they said, well, no, it's going to go back to whatever the normal drag is, and it's some odd million every single time instead of the huge boost that we saw in Q4. It wasn't that, and we don't know why. We don't know what that number is, where it's coming from. We don't know anything about it. It's just some number that's stuck there, and I don't like that as a shareholder. It's not like I don't trust these guys because I wouldn't invest. I wouldn't have them as my bank. In switching that over, by the way, I'm officially a bank customer, by the way, this week. Maybe it was a week and a half ago, but I'm signed on now. But man, like we've asked as investors, and it's frustrating to just beat our head on the wall and be like, hey, We want more information. Give us some more information, please. And the answer is, yeah, we'll get you more information, and then not. It's like, what are you doing, guys? Like, just tell us no. Like, that's fine. Don't promise us information or say, oh, it's going to be, normalizing in this negative number and it's actually positive, and not have any comments on it at all. Like, what is that? I'm not happy. So I feel exactly like I did with PayPal's previous quarter. I hold. I'm not going to add. I've resumed buying PayPal. I think it's, they've changed things around. Maybe we'll talk about the after hours. This is not PayPal thing. So I think SoFi next quarter may, do quite well, give us some more information. And at that point, but I'm like the market. I don't like what I don't know, because I'm like, there's no certainty there. And it makes me less comfortable as a shareholder to add. Like, I can hold, that's fine. But it makes me a lot less comfortable to add considerably, other than the little bit that I added, when I don't know that information, when there's a lot of unanswered questions. So that's where I'm at. Frustrated.
Shall we jump into the after hours?
No, I want to direct a comment to Chris Hager.
Sure.
This is an apology.
Oh, it is not an apology.
Okay.
Okay.
Elon Musk needs to fix X, is what it needs to happen. Because when I go on the app on my phone and post something from Seeking Alpha, even though I'm a paying member, I only get the 244 characters or whatever it is.
Mhm.
So I had to leave somebody off because I didn't have room. Unfortunately, it was him. That's why he got his own dedicated thread. And I can't believe Noto trolled me on that.
Here, let me find that
Are
for
you
you
not?
guys.
Are you not using a link shortener? Because that'll really cut down your characters.
But I shouldn't have to, because if I do it from a computer, I can type 1,000 words. It doesn't matter. But when I do it on my phone on the app and I bring it in from the link on Seeking Alpha to post on X, for some reason, it'll bypass it and I only get the original 255 characters.
Gotcha.
Very annoying.
SoFi Technologies sell off after double beat, guidance hike, another opportunity SoFi delivered again, and Anthony Noto and team did a phenomenal job at Real Matt Money, Future Investing, Fun of Investing, and Crossroads. That is myself, Matt Money, Tevis, and Roy. I don't see any.
Yeah, because I should be allowed to put more characters there.
I'm offended you didn't at me. No room.
No room.
I didn't know I would have been cut so deep. Anthony Noto said, personally, I would have included you. Ooh, that's gotta hurt, Steve.
Can't believe it.
Can't believe it.
Can't believe it.
But big up to Anthony Noto for involving a little bit more in this small little investing community.
Where is Hager, by the way? I thought he was coming.
No, I think he's busy. He's traveling, I think.
He heard you were on, and he's like, dude, I'm
Yeah,
so
I don't want
mad
to talk
at
to
him
that
for
guy.
not putting me on."
Boycotting Steve.
Yeah.
That's fine.
I am glad that you guys, just while we're in the last seconds here, were able to move the show. I know Tevis wanted to watch his Game 7. He wanted to place more bets, but he ended up moving the show over to Saturday to accommodate me coming back from Jamaica. So thank you guys. Love all ya. But until next time, hopefully you guys enjoyed the SoFi Weekly. Many more videos for me to come. I'm not taking another week off. Bye for now.